Well, the markets are waiting now for some rather key news from the Federal Reserve to be delivered today. The central bank is expected to raise interest rates for the first time in a year. CBS News business analyst Jill Schlesinger is here to break it all down for me. And so, quite simply, what kind of hike are we looking at here?
Quarter point, just like a year ago. But remember, a year ago was so different because the previous rate hike had occurred 9 years earlier. And so last year was a kind of a different experience. Oh my God, first rate hike, first since the recession. Now we're starting to normalize a lot. And frankly, even before the election results, the Fed was signaling a quarter point in December, really because the economy has improved. And it has. I mean, we have seen strength in the labor market. We've seen strength in manufacturing kind of resume a little bit. Construction's ticking up a bit. So we are seeing that there's a case to be made that the Fed should raise rates, get things a little bit more normal, because we're still at very low historical rates, and to catch up with economic growth.
Now, short of those Dow futures election night, we have seen the market run away and hide. It could hit 20,000, in fact, today. Will this news impact that at all?
I don't think the actual rate increase is going to do it, but we do have a Federal Reserve press conference after. Janet Yellen will get up and she'll take questions. So what do we want to know? We kind of want to know, hey, what's the pace that you anticipate next year? Now, I want to be careful with that because a year ago, Fed officials thought they would raise rates 4 times in 2016, and they will have done it exactly 1 time. Yeah. So they're not that good at forecasting in the short term. That said, it's going to be interesting to also hear what she thinks the economic impact of fiscal stimulus will be. What's fiscal stimulus? That means when the government spends a lot of money. We've heard President-elect Trump talk about we're going to have infrastructure spending, we're going to have tax cuts, we're going to have easier regulations.
The infrastructure, one of the few things we've seen bipartisan support for.
Right.
Really.
And so what is the net result? What do we expect that to do to the economy? Well, a lot of economists I speak to, they think we get maybe a boost by 0.5%. It may not happen all in 2017, right? Because if you have a president start in January, the actual dollars being spent is not going to happen until later in the year. So back-end loaded for next year. But what do we think that impact is going to be? If she starts sounding very much like, hey, I think growth's accelerating and this is good, then all of a sudden the market might get a little nervous. Oh, my God, what if they raise rates faster than we anticipate? Right now, most of the people I speak to, they think we're going to get 2 to 3 quarter point increases next year, then acceleration in 2018.
So what does it mean for Joe and Jill six-pack?
Well, I would love to have a six-pack. Okay, so what does it really mean? Let's say you are a saver. You might be thinking, oh my God, I'm finally going to get more in my checking, savings, CDs. Not so fast. A year ago, when we got that first rate increase, banks really did not pass that along to customers. They will start to slowly see a little bit more interest credited to their accounts, but it's still, again, historically low rates. So savers, you'll be okay. It's not going to be immediate. Stock investors should be fine, by the way, because if they go slowly next year and if the economy is improving, that's a good backdrop for stocks, especially banking stocks and industrial companies and energy companies as well. Okay, who are the losers? Borrowers, right? Borrowers have already seen mortgage rates jump ahead of this rate increase. Now, remember, short-term interest rates, which the Fed controls, that's not what is tied to your mortgage rates. It's the 10-year Treasury. 10-year Treasury, before election, 1.85%. Right now, it's about 2.5%. That's a very big move.
Yeah.
Mortgage rates up by 3/4 of a point on a 30-year fix. Credit card rates going up. Auto loans going up. Variable student loans, meaning not the ones from the federal government, from private companies, all going up. So you will start to see some pain if you are a borrower.
Big picture, how do you see Janet Yellen and President Donald Trump coexisting?
It's kind of amazing because when you think about what he said about Janet Yellen, she was really in his crosshairs.
Yeah.
Oh, terrible Fed. They've kept rates too low for too long. It's politicized. Now come into this year. If I'm President-elect Trump, I might believe that Janet Yellen is the best Fed chair I could have. Why? Because she is seen as a dovish Fed president, meaning that when she is when she's controlling policy, what she's doing is erring on the side of saying, I'll keep rates a little bit lower in order to foster economic growth. A hawkish Fed chairman would be the kind who says, oh my God, I'm really worried about inflation. I've got to raise rates as quickly as possible to fight that potential off. Now, keeping rates lower for longer for a sitting president is actually better. It does foster economic growth as long as it doesn't pop inflation up And as long as you are not seeing a case where you are getting criticized for sort of missing the boat, like, uh-oh, you're getting behind the curve. So it may be, after all is said and done, even though her term is up in February of 2018, he might like having Janet Yellen as a Fed chair.
Friends in the strangest places.
Right, they do. Politics always does make strange bedfellows.
Optics, optics, optics.
Indeed.
Jill, thanks.
Thank you.